All right, welcome everybody. Let's do a quick audio check for everybody else in the crowd. Type a 3 in the chat if you can hear me, please. Type a 3 in the chat if you can hear me and see my screen. All right, excellent. How you doing? Al, Mark, Jack, William, Ian. All right, guys, excellent. So I've got 45 minutes. This presentation usually is about 60 minutes long or so. So I'm gonna try to get through it very quickly, not blast through it so you don't understand, but I want to make sure I do get through all of the pertinent information, the meat of the strategy. So if I'm talking fast, that is the reason why. I want to make sure that you can walk away with a strategy, something that is truly actionable that you can begin applying immediately. And we're talking about even today, the rest of the trading session. So first off, I want to say thanks to Anna and the Investor Expos team for having me on. Like she said, this is my first time on the show, so I'm very grateful that I was invited, and looks like we've got a great lineup here behind me. So first off, welcome. Thank you for your time. I know everybody's got very busy schedules and other commitments, so I do want to say thanks for taking time out of your day to come listen to me. So my name is Silas Peters. I'm the founder, head trader of Seasonal Swing Trader. It looks like the audio and visuals are good, so let's go ahead and get started here. Before we begin, we must always start with the risk disclaimer as required by the regulatory governing bodies and our attorneys. Past performance is not necessarily indicative of future results. Only risk capital should be used to trade. There's substantial risk of loss associated with trading. So bottom line, Cliff Notes version means don't trade with your milk money, your mortgage money, your child's educational funds. You can lose money in trading. So while everybody is reading that, why don't you do me a favor? Tell me where everybody is from. I like to see who I'm talking to here. I am in LA, which is not Southern California, LA, but LA as in lower Alabama on the Gulf Coast. So where's everybody from? We've got Austin, Texas, Toronto, Germany, welcome. Tampa, Florida, Detroit, New York, the real LA, I hear you. Morocco, wow. Nigeria, wow. I can't say that I've had a Nigerian trader in here. St. Louis, Chicago. Ooh, yeah, I'm sorry about the snow. Colorado, UK. Awesome, awesome. Got people, we truly have a global presence. It's always very interesting to see where everybody's at, and pretty neat that we're able to do this thing on a global scale. So let's go ahead and get started here. Let's begin. I'm going to introduce myself once again. My name is Silas Peters. I'm a husband, father, son. These are my two beautiful blue-eyed, blonde-hair beauties standing in front of my alma mater at the University of Alabama in Tuscaloosa. And some other pictures of my family and I just hanging out. We love to get out on the water, whether it be beach, boat, just outdoors, hiking, golf course. You know, I spend a lot of time working, spend a lot of time in front of the screen, so any chance I can get out, I certainly enjoy that. So just want to show you that I'm a real human being. I'm not a robot. And 3 days after I graduated, I sold my car, I packed up my belongings, and I headed north. I drove straight north to the great city of Chicago, the old Windy City. And it's here where I cut my teeth in the commodity markets working at the Chicago Board of Trade. I was bitten by the trading bug, and I never really looked back. So while there, I helped run a global trading desk, managing books of trades across the Americas, Asia, and European sessions, primarily working with large block order flow for hedge funds, banks, CTAs, other large floor spec traders. Also been a part of building and managing several futures and equity brokerage firms, managing operations, trading, back office, sales, and support. I also worked as a private family office investment consultant. I hold or have held these various futures and securities licenses. And then in 2016, I launched Seasonal Swing Trader. And then we're also very proud here in 2020, launched our registered investment advisor firm, Blue Marlin Advisors. So we're very excited about that. But my journey wasn't always easy. There was a learning curve. In fact, several obstacles and hurdles on the path to where I am today. The first step was obviously learning. School does not teach real life experience in the markets. In the beginning, I made money. In fact, I made a substantial amount of money. Was I lucky? I like to not think that was the case, but ignorance and greed cost me my profits. I blew up an account. I blew up a few others and what I like to call revenge trading. I'm sure some of you can attest to that. Certainly not fun, but I chalk it up to part of the process. Finally settled down, went back to my roots, worked my process, and found overall consistency. But enough about me. Let's talk about you. Does anybody's trading desk look like this? Does anybody's trading desk look like this? This is actually a poor attempt at humor. This is not my trading desk. Found this on the internet. I thought it was funny because I feel like it's the perception of what those on the outside looking in at us traders think this is what we do. We're crammed down in a basement, surrounded by dozens of monitors with lines and numbers and CNBC in the background. And yeah, a lot of you are like, no, hell no. 8, okay. Well, so my desk did look like this in Chicago for obvious reasons, but I've since pared back to just a handful of monitors for quotes, charts, order entry platforms, and then the internet for day-to-day operational activity. But all this does, in my opinion, is leads to this paralysis analysis. So who here is or has been a victim of paralysis analysis? I'm raising my digital hand. I've been there, done that, got the t-shirt. For Wikipedia, it's a state of overanalyzing or overthinking a situation so that a decision or action is never taken, in effect paralyzing the outcome. So who here has done all the analysis they thought they could do, they've crossed the T's, dotted the I's, and then they have their finger on the mouse, get ready to pull the trigger, then whoops, what happens? This line crossed that line, or something pops up, thus negating our analysis and bias on the trade. So yeah, of course it has happened, and it's very, very common. And if it's not, congrats to you. But if you are a victim, hopefully today will help kick the paralysis analysis demons. So what do you trade? I'd like to see what kind of crowd I'm talking to. I appreciate the interaction so far. You trade stocks, options, futures, Forex, maybe even cryptocurrency. Let me know what you trade. I trade stocks, options, futures, and Forex on an active basis. Do not trade cryptocurrency actively. I do, of course, own Bitcoin and some other cryptocurrencies. I barely look at it, but of course, with the coins rallying right now, it is on the front of everybody's mind. But I do trade stocks, options, futures, and Forex on an active basis. So let's see what we've got. We've got a lot of stocks and options traders, FX and futures, all the above. Options, weekly options. Yeah, I mean, it's really all over the board, and that's usually what I see. Usually see stocks and options traders followed by futures, Forex, and then crypto in that currency, CFDs. Okay, cool. Yeah, well, that's great because what I'm going to share with you today works in all those markets. It's highly accurate. It's profitable, works in all time frames, and it's 99% mechanical. But most importantly, it is simple. So we're not here to teach rocket surgery today, folks. We're going to keep things very, very simple. So I have agenda and promise to you. We're going to learn a simple mechanical setup that is repeatable regardless of the market or time frame. And I'm going to ask you at some point during the presentation, have I fulfilled my promise? And I hope to see a lot of yeses. Speaking of promises, I'm not going to promise you anything today. Cannot promise you anything in trading or in life. But these were trade setups that we talked about in multiple free presentations, such as this one. This was a potential setup here in crude oil on the left, RBOB unleaded gas on the right. We actually had a third market in nat gas. We talked about a potential $10,000 trade setup in these markets. And they triggered based on the setup I'm about to teach you. They met their $10,000 trade setup and then some. We also talked about sleeper markets here in coffee and OJ. You can see here from 5, 15, and 30-year historical price perspective that the markets tended to bottom out or rally at this time of the year. Does that mean that we went and got long coffee, OJ? No, we said sit on your hands, wait patiently for this pattern that I'm about to show you occur, and that's what happened. They triggered and met their $6,000, $7,000, $8,000 per contract price objective. We also talked about markets in corn, beans, and wheat. This is corn on the left, beans on the right. So from 5, 15, 30-year historical price perspective, that the markets tended to bottom out or get quiet at that time of the year. That's precisely what was happening. We sat on our hands, we exercised patience for the pattern to trigger, and that's what happened. They triggered and they met their $5,000, $6,000, $7,000 per contract price objective. So this presentation is not all about futures or commodities. I'm just trying to show you that these set up over and over again. So who here is ready to see the setup responsible for these very recent trades? These very recent trades, this could be updated This is actually 800 S&P points on the left. This is actually 160 points here on Cocoa. This is 300 pips in the Aussie Kiwi. And then we've got two $20 trades for $40 here in Facebook. So absolutely, yes, you are ready to see the setup. So are you ready? Drum roll, please. It is the 1, 2, 3 top or 1, 2, 3 bottom. So who here is familiar with the 1, 2, 3 top or 1, 2, 3 bottom? Let me see who's familiar. So I see a lot of yeses. That's not surprising. I would expect at least 99.8% of you to be familiar. I didn't invent it, but it's one of the most fundamental technical patterns in the textbooks, but highly, and I mean highly, overlooked by most traders. So those that are not familiar, you're going to be quite enlightened. And if you are familiar, you're going to wonder why you're not using this in your strategy. So let's take a look at the setup. It's price action based. The pattern is comprised of a low and a higher high and a higher low and a break of that higher high in the case that we're going long. Same rules apply, but only inverse if we're looking to go short. It anticipates a change in trend from up to down on a break below the 2 or B point. Anticipates a change in trend from down to up on a break above the 2 or B point. The strategy usually occurs at the end of trends and swings. Can be an indication of a change in trend. Can also be found within a trading range. So you may argue, is this a counter trend strategy or a reversal type strategy? And in essence, it is, but we're going to talk about ways later how we can filter these out. We'll say that it works extremely well when the pattern sets up at significant areas of important support and resistance. Other high probability patterns such as head, shoulders, tops, and bottoms, double tops, double bottoms, and more. Let's talk about the mechanics. 1, 2, 3 top. This could be Caterpillar, this could be Walmart, this could be Litecoin, this could be the Swiss franc versus Japanese yen. It doesn't really matter. We're learning the basic principles and mechanics. So for a 1, 2, 3 top, we get our number 1 point here when we find the highest peak, find resistance, and then move down. We get our established number 1. Once we start moving lower and stop making higher lows and pull back, we get an established number 2. And once we retrace back to the downside, that gives us our number 3. Now, we could have retraced up here, or even up here. As long as we don't take out that number 1 high, we have a 1, 2, 3. And for a 1, 2, 3 top trader, we know that we're looking to get short on breaks or closes below the number 2. Let's talk about the 1, 2, 3 bottom. Same rules apply, but only in inverse. So here we have the lowest low as support, which is our number 1. Market retraces higher, pulls back, giving us our number 2. The market pulls back. Once we stop making these higher lows and pull back, we get our number 3. Again, the market could come here, or here, or here, as long as we don't take out the number 1 low. We have a 1, 2, 3. The 1, 2, 3 bottom traders are looking to get long on breaks or closes above the number 2. So let's look at some chart examples. We'll start here with the 1, 2, 3 top. And this is a daily chart of the Aussie dollar, the 6A futures. If you don't trade futures, you can look at the ETF FXA that tracks the Aussie, or if you don't trade futures or ETFs, you can look at the Forex pair, the Aussie US. You're going to see the exact same pattern. Now, this is a daily chart of the Aussie, and you can see point 1 here has put in a 52-week high. Now, a 52-week high or 52-week low is not an absolute requirement. Nothing set in stone. We're just going to use a 52-week high or 52-week low for these example purposes. Now, we have a number 1. Why? Because it's a 52-week high. The market pulls back, retraces up. We get our 1, 2. Now, we only retrace higher by about 4 or 5 bars here. Again, we could have come up here, or up here. As long as we don't take out that 1 high, we have a 1, 2, 3. Now, we pretty much know the rules of the system already. We know with a 1, 2, 3 top, we're looking to get short on breaks or closes below the number 2, which is what we get here. But what about the other important ingredients of the recipe? Like, where do I put my risk? Where am I put my targets? Where am I taking profits? It's all very important questions. So our initial risk is above the high of the number 1 up here. Our initial target is the distance between the high of the 1 measured to the low of the 2 measured down. So we measure from here to here and then down. It's about 225 ticks for $2,200 per contract in this example. Trader says there's no sound. Testing 1, 2, 3. Just want to make sure we have sound. Test, test, test. Okay, I think that was just independent to Trader. Okay, so you're going to notice that immediately off the get-go, it is a 1-to-1 risk-reward ratio. We'll talk about ways later that we can improve that, but I'll give you a hint. Once the market starts to break down in our favor, it's very important to let the market begin to materialize in your anticipated direction, which it does more often than not. Once we start breaking down, we can quickly adjust our stop to the next logical area of resistance, which is where in this case? Above the high of number 3. Once we start breaking down, we move our stop from here to here. We quickly cut our risk by 60 or 70%. Let's look at another 1, 2, 3 top. This time it's the daily chart of Walmart, WMT. We put a number 1 point here. Why? Because it's a 52-week high. We have a 1, 2, 3. We know in advance where 98% of other traders are asking themselves, well, where am I going to get in? Where's my stop? Where are my targets? We know that days in advance. We already know days in advance that we're looking to get short on breaks or closes below the number 2. We know our initial risk is above the high of the 1. We know our initial target is the distance between the high of the 1 measured to the low of the 2, measured down, which is about $5 in this example. Let's look at some 1, 2, 3 bottom example. This is a 15-minute chart of the E-mini S&P. Now, on an intraday chart, whether it's a tick, 5-minute, 30-minute, etc., obviously we're not looking for 52-week highs or 52-week lows. It wouldn't make much sense. So on an intraday chart, we're looking for what we call session highs or session lows. So wherever you start your trading day, you're looking for new highs or new lows of the session to begin your new 1, 2, 3 bottom or 1, 2, 3 top counts. So we have a red 1 circle. This is an intraday session low. 1, 2, 3. Let's talk about entries. Now, aggressive traders may look to get long on the initial break above the number 2. So you're working a buy stop a tick or 2 above the number 2 high. You're triggered into the trade. A couple of alternative entries that I prefer are either to A, wait for the market to come back and retest the breakout area, which it often does, or wait for the market to hook back up above the breakout area. So a couple things are going to happen. One, you're going to miss out on some potential profitable trades. Sometimes the market will bust up out of the number 2, zip up the profit target, and leave you at the train station. No need to get your feelings hurt. There's plenty of other trade opportunities around the corner. But what is it also likely going to do? Sometimes the market will come up, roll back over, roll back, come down and stop you out. So this method will keep you out of some potentially false breakouts. So you see we bust up, we wait for the market, it retraces down, it rolls back higher, and we're triggered into the trade. One more example on the 1, 2, 3 bottom. This is a weekly chart of Apple. Hell of a way to catch some longer term position type moves. Here we have a multi-week low. We also have a high probability double bottom. 1, 2, 3. Market breaks out above the number 2 here on this large bullish candle. Trades sideways for a few weeks. Market comes back down, retest, looks back above. That's our confirmation to get long. How? We buy Apple stock. We can buy call options, call spreads, sell put credit spreads, trade Apple CFDs. The list goes on and on, whatever suits your trading style. Let's talk about failed trades. They don't all work. There's no holy grail in trading or in life, but I know we're all big boys and girls. You already knew that. This is a trade I probably took in my live account. 5-minute chart of the E-mini S&P, large vertical uptrend, trend line break. 1, 2, 3. Those early traders may be getting short right here on the initial breakout. Or if you wait for the hook method, the market comes up, hooks back down, you're into the trade. You're up by maybe 1 or 2 points. I'm not real sure. If you exercise any type of money management, you're stopped out at the next risk level here above the number 3. If you sat on your hands and didn't do anything, you're stopped out above the high of the 1. But look what happens. We get a new setup. This high is greater than that high, so we start the count over. 1, 2, 3. Market breaks down below the number 2, ends up being a profitable trade. This is a no trigger or voided trade. It's neither good, bad, nor ugly. It's just a voided trade. So here we have a 1, 2, 3, looking to get long here. What happens? The market rolls over, takes out the number one low. We start to count over. 1, 2, 3, looking to get long here. Market rolls over, takes out the number one low. We start to count over. 1, 2, 3. Finally are able to trigger long here on this third attempt. So let's recap the trade management, the confirmation of entries on a break above the 2 or B point for a long, or a break below the 2 or B point for a short. Exit strategies. If you're only able to trade one contract, one futures contract, one FX contract, one option contract, I would say strive for the distance between the 1 and 2 point. If you have the flexibility to trade multiple contracts where we all want to be, I would say, hey, scale out of your position, a third, a half, 2/3 your position at that distance between the 1 and 2, because it's uncanny how more often than not it will go tag that and then often reverse. And then you can trail your position however you manage your trade. Nobody can tell you how to manage your trade. You got to figure out what works best for you. You can use good old-fashioned structure, support resistance levels, trend line breaks, moving averages. The list goes on and on. You've got to figure out what works best for your situation. So I've showed you the setup works in any market, whether you trade pips and Forex, Pepsi stock, potash or pot stocks, pork bellies, or the Polish zloty. Also showed you works on any time frame, whether you trade a tick, 5-minute, hourly, 4-hour, daily, and more, and any trading style. What is everybody's trading style? Are you a position trader, scalp trader, day trader, swing trader? Let me see if I can answer some questions while you are typing that in. I didn't call it the Holy Grail. I didn't call it the Holy Grail. Swing, day traders, tick, all of the above, a lot of swing traders, scalp. And I ask that because you've got to figure out what your bread and butter is. Like I said, nobody can tell you how to manage your trade. Nobody should tell you that the 5-minute is the best situation. The 4-hour is the best time frame. These are time frames that I found work for me based on the time I can commit and the time that I like trading these strategies. You have to figure out what works best for you. So you've seen the proof. Let's look at some real trade examples. Not to say that what we just looked at were fake examples, but let's look at some trade examples we've utilized in some of our services. So this one is crude oil. Everybody's familiar with crude, whether you trade CL futures, USO, maybe other energy markets, ETFs, and so forth. Here, I'm going to work myself from left to right. You can read the text over here on the right. So we have 3 examples. This one is a new number 1 point. Why? It's a 52-week high. 1, 2, 3. We know in advance where our entry point is, where our stop is, where our profit targets are. We're looking to get short on breaks or closes below the number 2. Our risk is above the number 1 high. Our target is the distance between the 1 high and the low 2, or $3 or $3,000 per contract. We quickly meet our profit objective, and then we go sideways. We get into range-bound consolidation mode. I get asked all the time, does it work in range-bound markets? Well, technically it should, right? Because we're only looking for new highs or new lows. But if you want to, I'm only looking for new highs or new lows. But if you want to trade range-bound 1, 2, 3s, by all means, help yourself. We get a 1, 2, 3, market trades higher, ends up into profit. We get a new number 1. Why? This high is greater than that high. 1, 2, 3. Let me tell you why I got excited about this pattern. Well, 1, because of the high probability 1, 2, 3 top that we've been talking about. Secondly, we're at a time of the year from a seasonal perspective where crude and energy markets in general tend to trade to the downside. So we got excited and we got short this market. We sold crude futures, we sold bear call spreads, we bought put spreads, and we met our $4 or $4,000 per contract price objective. And then we ended up trading down another $20,000 per contract. We didn't catch that entire move, but we damn sure caught a large chunk of it. All we did is we trailed the market until we either got a reversal or we got stopped out. We have a potential 1, 2, 3 here. This is a market 1, 2, 3. Looking to get long here. In fact, from a seasonal standpoint, this is an area where energy markets typically go to the upside. But what happened? The market broke to the downside another $10 or $10,000 per contract. We finally got one last flush low, 1, 2, 3. Market broke above, met our $5 or $5,000 per contract objective. Let's look at another chart. This is gold. Actually, this is GLD, the ETF that tracks gold. I like to look at the futures market first. You're not going to see all the gaps. It's a lot cleaner, but you're going to see the same pattern regardless. So here we have a 1, 2, 3. Market breaks below the number 2, gives you a couple of retests, meets our $4 profit objective. Now we get a new one setup. This is a new low, 1, 2, 3, also double bottom. Market breaks above the number 2, we get long, reaches our $2 profit objective. Then we go sideways. So that's like that crude example. People say, well, you missed this huge move. Maybe I did, maybe I didn't. I'm only looking for new highs or new lows, but we have a nice little 1, 2, 3 boom to the upside, nice little 1, 2, 3 boom to the downside. Here we start making new lows. These lows are lower than these lows. So we start to get a new 1, 2, 3 count. 1, 2, 3. Look, I don't know if you can see that. Market gaps down, takes out that number 1 low. So we start to count over. 1, 2, 3. Market gaps higher 2 days in a row. Boom, boom. Comes back down and retest, and it hooks back above. Also gives you a trend line retest. That's our confirmation to get long. We can buy gold futures. We can buy GLD. We can buy call options, call spreads, or sell out of money put spreads. Let's look at another example. Delta Airlines is probably becoming redundant by now. Just trying to show you that it happens over and over again. 1, 2, 3, gaps up, comes back and retest, trades and meets our $4 profit objective. Here we get another one. 1, 2, 3, gaps below the number 2 breakout area. I don't personally trade the gaps. I like to wait for the retest or the hook back down. We get another one here. 1, 2, 3, market trades aggressively down below the number 2. We get a small retest, ends up trading $8 lower. And then we get a 1, 2, 3 here. Market trades higher, then higher, pulls back, and then ends up making an $8 plus move. And then for the Forex traders, it's a 4-hour chart of the CAD Swissy, Canadian dollar versus Swiss franc. Here we have a multi-session low on a 4-hour, also double bottom, 1, 2, 3. Again, the aggressive traders may be getting long here. Or if you wait for the retest or the hook back above, you're into the position here. We meet our 70 pip profit objective. Now we just sit back and we wait for new tops to form. 1, 2, nope. 1, 2, nope. 1, 2, nope. 1, 2, nope. Finally get a last 1, 2, 3 top here. It's smaller, but with 1, 2, 3 top, trades down, trades sideways, meets our 40 pip profit objective. 5-minute chart NASDAQ. You get asked all the times at work on intraday charts. Of course it does. Here's a 5-minute chart of the NASDAQ. 1, 2, 3, market breaks above, comes down, looks back above, you're into the trade, reaches our 13-point profit objective. 1, 2, 3, market breaks below the number 2, trades sideways a little bit, have to pop some tums, finally breaks down, hits our 20-point profit objective. This is likely the last hour of the day. Here we get a 1, 2, 3, breaks above. If you're lucky enough to get long on the retest here, you meet your 30-point profit objective in about 2 or 3 bars. So why are you here? You're here to learn my mechanical done-for-you strategy for all markets in all time frames. This is a part of the presentation where I ask, have I fulfilled my promise? I'm going to take a swig of water here. Have I fulfilled my promise up to this point? And if you type in no, at least tell me why, because I don't know how to make my explanation any easier. But if there is a way, I will certainly try and do so. All right, perfect. All right, so if that was good stuff, I got to say, but wait, there's more. You knew it was coming. Usually when somebody says, but wait, there's more, it doesn't end well. But I can promise you in this situation, it will. What if the strategy was automated? What if the strategy was plotted onto your chart for you? What if the trigger entry and the targets were drawn for you? And what if your platform could scan the markets for you and tell you when there's a pending setup? I don't know about you, but I would say that would be amazing. So do you remember the examples we just talked about? Crude, gold, delta, do you remember all those? Excellent. So let's look at those again. This is that exact same chart we just talked about in crude oil. But now we've got some things going on. We see some colorful arrows and colorful lines. You're smart boys and girls. I'm sure you already figured it out, but let's talk about it. We have a green, red, blue arrow. The green arrow is your number 1. The red arrow is your number 2. The blue arrow is your number 3. 1, 2, 3. Pretty simple. Now, what about the white chevron or white sell signal? That's not a sell signal. This is not a buy signal. This is simply a visual aid telling us that, hey, we've broken or penetrated below the number 2 low, or we've broken or penetrated above the number 2 high. So if and only if we get a break of that number 2 low or that number 2 high, we're going to get the white chevron. And if and only if that happens, we're going to get these 4 beautiful lines appear on our chart. Well, what are the lines? The blue line can be considered your entry or your breakout level. Your red line is your risk or stop level. Your lime green line is what I call TP1 or profit objective 1. And your dark green line is TP2 or profit objective 2. So if you recall, TP1 is just simply the distance between the high of the 1 measured to the low of the 2 measured down. And TP2 is 2 times the distance of TP1. Now these green arrows, why do we see all these green arrows? It's because it's telling us that the market is making new lows. New lows, new lows, new lows, new lows. Once we stop making new lows and pull up, we start to get our number 2 count. Notice that we never broke above the number 2, hence no chevron, hence no lines. Let's look at the gold example. 1, 2, 3, market triggers, hit TP1, TP2. Here's this range-bound action. We don't get any prints because we're programmed to look for new highs or new lows. Down here, we're clearly trying to look for a bottom, so we start to get new lows, which is what we get. 1, 2, 3, market breaks above, so we get our lines plot, TP1, TP2. You can see that we're looking to make a new 1, 2, 3 high over here. Here's the Delta Airlines example. There's a long, there's a short, there's a short, there's a long. 5-minute NASDAQ. 1, 2, 3, market breaks below, hugs the breakout area, hits TP1, hits TP2 to the tick. Notice that TP2 actually happened to be a new session low, so we start a new count. 1, 2, 3, market breaks above, hooks back above, hits TP1, doesn't quite hit TP2, but it's good enough for government work. Here we have a new session low, 1, 2, 3, market just nips its head above the number 2 high, comes down, pulls up, retraces back, hits TP1. As we're looking for TP2, notice that we start to get new session highs. So that clues us in. It says, hey, we may need to get ready to short this puppy. But we end up hitting TP2, and we finally get our 1, 2, 3. 1, 2, 3, breaks below, retraces up, looks back down, TP1, TP2. Now, is this training for you? Only you, and you only can answer that. If you're new to the markets and want to jumpstart your success, if you're an experienced trader and want to add another arrow to your trading quiver, if you're tired of all the noise that we talked about, the paralysis analysis, if you just want to add another strategy to what you're already doing, whether you're successful or not, or if you want a very specific step-by-step mechanical plan that you do part-time, this training could be for you. Now, I like to tell a little story here. I hope I have time. But when I had this built out, I brought my wife down to my office who teaches ballet part-time. I brought my 2 girls to my office who were like 4 and 5. They don't know a flying flip about the markets. And I showed them what I was attempting to do with what I just showed you. And of course, after they settled down, after seeing the candles and the colors and this and that, they got it. They understood it. So my point is if that they can understand it, then you can too. All it takes is knowing how to count to 3, knowing your primary colors, and using some common sense. So I do have a special offer for today's workshop attendees. We limited this to the first 25 people because we actually take care of our members in our community. And it's going to be the 3S code high-low indicator and scanner. We've had this built for Thinkorswim, TradeStation, NinjaTrader 8, TradingView, and MT4. You're also going to get a chart pattern principle PDF made on trading guide, chart pattern cheat sheet, 25 type option strategy guide, VIP email support, and access to our private Discord channel. So what is the 3S code high-low indicator and scanner, you ask? Let me refresh your memory. This is the 3S code on a daily chart of CRE. There's a short, there's a short, there's a long. Daily chart of Bank of America, there's a long, there's a long, there's a long. Daily chart of Love, Southwest, short. His TP1 at the tick. Here's a short. Whoops, bad trade. That one's a loser. We get another chance to go short. Now, why do all the work when you can let technology do the work for you? This is a screenshot of my Thinkorswim platform. I'm scanning for 1, 2, 3 tops in the Russell 1000, only stocks that are optionable, $20 a share or greater. I hit the green scan button, voila. What would take years to find takes seconds, and a screenshot of my watch list. I have a one monitor dedicated to watch list where I'm scanning multiple markets, multiple asset classes all at the same time. We've been looking at TOS. This is what it looks like on TradeStation. Here's your indicator component. Here's your scanner component. Here's what it looks like on NT8, your indicator component, your scanner component. Here's what it looks like on TradingView, 4-hour chart of Apple. And here's what it looks like on MT4, 4-hour chart of the Euro Kiwi. Long, short, short, long. Full disclaimer, there is no scanner available on MT4 or TradingView. It just simply doesn't exist. If you know a Russian programmer, introduce them to me. We'll have it built out, but you get the indicator for all 5 platforms, the scanner only for TS, TOS, and NT8. Now, we know there's no real crystal ball in the markets, but I like to view this as one that provides me with a daily process. I let the platform scan the markets for me, locate the setups, I go to my platform for entry, and I manage the trade through the exit. So you can start doing so today with the 3S code. Here's your special offer. 3S code high-low indicator scanner for Thinkorswim, TradeStation, NinjaTrader 8, TradingView, and MT4, chart pattern principle, PDF manual trading guide, chart pattern cheat sheet, 25 top option strategy guide, VIP email support, and access to our private Discord channel. We've recently offered this online, no joke, at $19.97, $14.97, and $9.97. But for the first 25 spots for this live webinar, Investor Expo special, we're pleased to offer this for a one-time fee of $397. Yes, that's a one-time fee. You own the indicator, scanner, and all the educational material for life. I'm going to pop that into the chat. It's seasonalswingtrader.com/code. Hopefully you can see that. I put that in the chat. seasonalswingtrader.com/code. Now, I know there's a lot of questions, but I want to show you and make sure you understand exactly what you're going to get. The indicator and scanner includes a visual plot of the 1, 2, 3 top and bottom reversal areas as we just showed with the entry, exit, stop levels. You can customize the settings. If you don't want arrows, you want hashes, you want to change it from red to hot magenta. You can scan for setups only, trigger only, or both. You can scan for tops, bottoms, or both all at the same time, as well as intraday setups, swing setups across multiple asset classes. If you want to find more opportunities, you have the ability to adjust your settings to find to adjust the time frame or the value, the look back period, if you will, to find more, or expand it out to find less opportunities. Bonus one is the 90+ page PDF manual. You can print it out, download it, use it for firewood. I don't really care. You're going to learn additional strategies, patterns, how to identify trends, and more. Bonus two is a 25 top option strategy guide. Literally strategies for all account sizes, whether learning to trade basic calls and puts to more advanced, such as verticals, condors, butterflies, diagonals, and more. Bonus three is our private access Discord channel. We have channels in here for stocks, futures, commodities, Forex, intraday, swing. It's a very nice little hub. It's not a trade room. I will call it a chat room if you want to call that. It's open 24 hours, 7 days a week. You can post your charts, analysis, questions, what's working, what's not. There's a lot of markets out there. Nobody can possibly follow them all, so you can alert all of us to what you may be looking at. Here are some unsolicited testimonials. I don't ask for these. They come in all the time. But I'm very humbled and pleased, but most importantly, I'm pleased to see that people are taking action. That's the only way that you're going to see results. Here's an example from one of our other alert services. These were trades that were using nothing but the 3S code that you just saw. Look at the profits made on the 3S code. These were all real time. And I do eat what I cook. Eat what I cook. These are screenshots of my Thinkorswim platform where I do my equity options trading, in my futures platform where I do my futures and futures options trading. You see, I got crude options, cotton options, copper options, yen options, nat gas options, the S&P. And then finally, let's just conclude here with one last screenshot of a S&P chart. This is a 233 tick. Just nice, easy, clean, simple setups. Okay, so let me get to your questions here. Here's the offer again. 3S code, you own it for life. You get it for Thinkorswim, TradeStation, NinjaTrader 8, TradingView, and MT4. You get the indicator for all of those platforms get the scanner for Thinkorswim, TS, and NT8. Let me go here and look. Yes, you do get the scanner and indicators I just mentioned. You do not have to notify me about what platform you're using. You get access to all of them immediately. You're welcome. Yes, you should receive your purchase email within just 1 or 2 minutes. Check your spam folder. If you didn't get it for some reason, it's very rare that it goes there, but it does happen. We do have a support team that can actually log into your computer via a remote session. He can log in and install this for you, but if you're able to log in today into this webinar, you should have no trouble. It should take you 5 or 10 minutes. Yes, you can run it on multiple platforms at the same time. Yeah, you can use it for crypto trading. I don't trade crypto actively, but you can certainly plot cryptos. So I know like TradingView is a free platform. I don't know what else you may be using. Maybe MT4 could plot cryptos. I'm not sure what else. But MT4 and TradingView do plot cryptos. I'm not sure about the other platforms. Pro real time. Yeah, those were all real time charts. They appear in real time. No, there's no repainting. Discord channel is kind of like a little chat room, if you will. We have different channels, so if you don't trade FX, you can just ignore that channel. If you don't trade stocks, you can ignore that channel. Link is seasonalswingtrader.com/code. Yeah, we talk about in the members area. We have a lot of guides, how to, best practices for using it to intraday trade, best practices to use it for swing trading, as well as options. If you ever have any questions, you can email me direct at support@seasonalswingtrader.com. The strategy is very reliable. I've seen a lot of strategies, a lot of methods. I'm not saying any method or strategy out there is wrong, but this is a strategy that I've gone back to time and time again, been using it for 15 years. You can load as many charts as you wish at the same time. Does not work on Trade Navigator. These are the platforms right here. Thinkorswim, TradeStation, NinjaTrader 8, and TradingView. Let me see if I got a couple minutes here. All right, so this is the Discord channel. This is what it looks like. Just posting charts, analysis, thoughts, scans, so on and so forth. This is what the members area looks like. You're going to see the Discord information, the resources, bonus materials. Here's your Thinkorswim installation, TradeStation V10, V95, NT8, TradingView, and MT4. Yes, you can email us. Your support access does not expire. You can email me today. You can email me 365 days from now. You're very welcome. Khalifa, email me at support@seasonalswingtrader.com. I think my time is up. I want to say thanks to everybody. I appreciate your attention, your interest. Thanks for everybody that joined. It looks like we saw 11 spots have been taken. We'll leave this up through the weekend. And I want to say thanks to you and the Investors Expo team. Thanks for having me. A really great crowd in here. You guys stick around. Looks like we've got some great speakers coming up. Everybody have a great weekend. Happy holidays to those celebrating. Take care. Stay safe out there. We'll see you on the flip side.
Morning, everybody. My name is Michael Valtos, and today I'm going to be talking about order flow. That was just a great presentation by Silas earlier, and it's just fascinating. There's so many different ways to approach the market, and what I'll be talking about is the way I approach the market. People trade very short term, medium term, long term. Order flow is on the very short term spectrum of trading. So in this training, I'm going to show you how to identify aggressive traders, trade in sync with the market, and I'll talk about a low risk order flow trade setup, right? We all like to have trades, but we also want to have low risk trade setups, and I'm going to be talking about that a little bit later. Now, if you stay till the end, I'm going to show you how to get a copy of the book that I wrote on order flow. It's called Trading Order Flow, and it's going to teach you how to determine what the institutions are doing. It's going to talk about how not all prices are the same, how to limit your risk on a trade, how to determine price rejection, how to understand value in the market, and much more. So if you stick around till the end, you can be able to get a free copy of this. It'll be a digital download. It's not going to be the actual hard copy. Now, why order flow? Well, to me, order flow is the market, right? It's not some indicator or Fibonacci or pivot points, right? Order flow is the trading that's occurring in the market as as people are buying and selling in the two-way auction, and only order flow gets you as close to the market as possible. Now, people are going to say, what does that mean, get me as close to the market as possible? Well, now everything is screen traded, okay? And in the old days, there used to be the trading floor where people would pay a lot of money to be members on the trading floor to see who's buying and who's selling. If there's a lot of volume coming into the market or not, as opposed to just looking at ticks on the screen. Now, what order flow does is it allows you to see that volume in the market. And once you understand order flow, you're going to understand the market, right? This is all the charts I'm showing you is from yesterday, right? The December 16th. I like to keep it current, to show you that what I talk about happens every day in the market. So this was the E-minis. I'm going to show you how to see what other traders don't see, which lead to the big moves in the market. S&Ps, all these markets nowadays, a lot of volatility. You get big moves intraday, which is great. This is Japanese yen, right? By using the order flow, you're going to see and understand what's happening in the market more clearly. This is wheat, right? A nice move from the low of the day straight up. And I'm going to show you how to easily read an order flow footprint chart. This is an order flow footprint chart as opposed to a normal bar chart. And you're going to see there's a lot of information if you know what to look for. I'm not saying you have to analyze every tick. That's what some people will have you believe that order flow is about analyzing every single tick that goes through and trying to, sort of put it in pieces of the overall trading puzzle. So before I get started, I want to talk about who I am and why you should listen to me about order flow. So if this is the first time you're at one of my presentations, my name is Michael Valtos. I've got over 25 years of professional trading experience. I started on the CME floor in the early 90s with Dean Witter Reynolds. I literally started at the bottom. I said, I want to be in the finance industry. I started as a runner on the CME floor. That's the lowest you can start. Okay, and eventually, I worked my way up from there. After I left the CME trading floor with Dean Witter, I went to the electronic trading desk, which is when the electronic market started becoming popular back in the early 90s. And I spent a few years there. Then I left Dean Witter. I joined the global macro trading desk at EDF Man. It's a big English trading company. I spent a couple of years there. Then I joined Commerzbank. I became the licensed Eurex trader in Chicago. The only one in Commerzbank in Chicago that was able to trade Bunds, Bobbles, Schatz, DAX, all the German products against the U.S. products. After that, I joined Cargill, the big American commodity trading firm. I think now it's the second largest private firm in America. Koch Industries, I think, just became first, but it accounts for about 30% of grain exports and about 25% of meat exports. But they trade anything around the world that's tradable. Cargill's got their fingers in it. After Cargill sent me out to Singapore actually to set up a trading desk for them in Singapore when the trading floor on Cymex closed down. And so after a few years at Cargill, I left and I joined JP Morgan, Vice President of Futures Trading. Sat on the trading desk. I wasn't sitting in a corner office looking at charts. No, I was on the trading desk banging out trades all day long from 6 in the morning when Globex reopened in the US until about 5 o'clock in the evening Singapore time. And in 2013, I left JP Morgan after my daughter was born to spend more time with my family. I just needed to get away from the corporate rat race and trade for myself. I started writing my book, and in 2015, I started Orderflows. Okay, but this presentation is not about me, right? It's about showing you how you can improve your trading by understanding what's happening in the market. Use order flows. This is one of my users, who writes to me. I can clearly see now what's happening in the market. For example, who's in control of the market on a very specific time and who's getting weaker as well, right? I want you to understand what's happening in the market. Now, disclaimer, The charts and tools that I use in this training are generated from my order flow software, right? I said in 2015, I started a software company called Orderflows. And what I'm going to be talking about today can easily be applied with other order flow footprint software if you know what to look for. I find mine, I created my software to help my own trading. That's how order flows started, right? I was using another company's order flow tool, but it wasn't good enough. It was just a very basic thing. And I said, you know what? Computers should be able to do a lot more than just plot data on there. I wanted it to help me do the analysis so I could look at more markets and sort of, cover more things. So I'm going to show you how to easily and quickly apply order flow analysis to your trading so you make better trades, right? Low risk trades. Now, before I begin, I just want you to understand, trading is risky, right? You should only trade with capital you can afford to lose, and make sure you got sufficient capital that's separate from your living expenses. So what I want to talk about today is, aggressive traders, right? People say, what's aggressive traders? Well, being able to identify aggressive traders is the easiest way to make sense of the order flow, right? Order flow is about identifying the immediate trends of prices, right? Where the next 4 or 5 ticks are going to be, and if this move is going to continue, right? An order flow trader makes decisions from each succeeding trade in the market. Think of the market as a kaleidoscope, those things you look into and you twist it. Order flow traders are always gauging the supply and demand and the forces behind it. But what really causes a market to move? It's the aggressive traders. But what exactly is an aggressive trader, right? This is a picture of a trading dome, okay? And you see there's bids and there's offers, right? There's the best bid, the best offer, right? Markets trade in a two-way auction. A lot of traders don't even think in terms of the two-way auctions. You just think of, well, the price, the market traded 36.91. But you can see here, right? It's 91 bid at 89 and 3/4. Okay, so it's kind of a wide bid offer, but because I left out 36.90. But you can see people that are working on the bid and below are what's considered passive buyers, right? You can see the 101, the 164, the 296, the 264, the 289. All these people are what's considered a passive buyer. They're waiting for the market to trade down before they buy. Whereas passive sellers are those on the offer and above. They're happy to sell at 36.91 if the market comes to them. They're happy to sell at 91.25 if the market comes to them. There's no rush to trade, right? They're considered passive sellers. So you have an order book, right? The order book is full of passive buyers and passive sellers. But the aggressive traders are the ones who cause the market to move. There's a saying, in the old days, you used to be able to have to call your broker, why did the market go up? And he would say, well, there was more buyers than sellers, okay? Well, that's really misinformation, disingenuous information, because what's actually happening on a move up is there are more aggressive buyers than aggressive sellers, right? You have passive buyers here, but there's more people buying the offer, buying everything out at this level, 36.91, clear it out. They buy everything at 36.91.25, right? So there's not more buyers than sellers. What you have is more aggressive buyers than passive sellers going on. That's what's causing the market to move up, because they're clearing out all all the offers in the market on the way up. Just as on a move down, there's more aggressive selling than buyers. So markets don't move because a trader's working bids and offer. Okay, and a lot of people that trade on a dome, they actually, they sit there, they like to look at a dome, just like this, right? Stare at your screen and see it flashing back and forth, big numbers coming in, and they may see a big offer or a big bid come in, and they try to jump in front of it. That's one of the deadliest things to do, actually, is sometimes jump in front of a big order, in the sense that it's just sitting in the book. Okay, because even though there's laws against spoofing, it sort of does still happen in a way. People think that, oh my gosh, there's a big bid at 36.89. I'm going to buy, the 89.25. I'm going to just jump in front because there's a big buyer. They must want to get it. But speaking as an institutional trader, right? I did that for, over 20 years. Is as a big trader, when you see big size in the market, that's your opportunity. If you know if we want it to sell, and someone shows 36.89 bid for 800, and I got 1,000 to sell, even though the market is trading 89 and three quarters bid, I just hit it all down to 89 because I know that I'm such a big trader. I've got a lot of supply to sell. If I see a big bid there, I'm just going to hit it because I have so much to sell that eventually my selling is going to move the market down. So if somebody puts a big bid in there, I'm just going to whack it. Okay, so that's not what a lot of retail traders think. They actually think the opposite. They think, well, there's a big buyer, a couple ticks below the market must be going up. That's not what moves the markets, right? It's the actual trades that move the markets. So for a trade to happen, the aggressive buyer has to cross the bid offer and lift the offer, right? Aggressive buyers buy from the passive sellers. Aggressive sellers, on the other hand, they cross the bid offer and sell into the bid. They sell to the passive buyers. All right. So, again, think of the two-way auction. There's a bid and there's an offer in the market. So trying to watch order flow on a dome is hard. It really moves so fast. And if you look away to sip of water or pick up your phone or something, you could miss something important in the market. But an order flow chart, right, a footprint chart is really, what I consider the only chart you need to look at because it has a lot of the information. And what's beautiful about an order flow chart, a footprint chart, is, like the previous speaker, Silas, right? You can actually put those tools on a footprint chart and you can find better trading opportunities because you're going to see what's happening in the market, right, with the aggressive traders. Okay, so you can see, there's a lot of numbers here. People get scared. They look at a footprint chart and think, oh my gosh, so much numbers. I don't know what to make of this. But when I first walked on the trading floor at the CME, I thought it was complete chaos. But after, a day or two, after it was explained to me what to look for, what I was looking at, I understood it, right? And a footprint chart is the same way, right? You'll see the volume traded on the bid, the volume traded on the offer at a price at a two-way auction. You can see where markets are strong, markets are weaker. There's just so much information on there. You can see where the aggressive buyers are present. You can see where aggressive sellers are present. So aggressive traders, how by now hopefully you can understand what an aggressive trader is, right? It's someone that wants to get filled, basically, right? The passive buyer or passive seller is just someone happy to sit on the bid or the offer and wait for the market to come to them. But an aggressive trader says, you know what, I want to get filled. I need to get out of this position, just sell it at the market. That's an aggressive trader. Okay, and aggressive traders cause imbalances in the market and can be seen in the order flow footprint chart. Now, aggressive trading can also be seen in the order flow delta number. So delta and imbalances are two of the most important pieces of market generated information from the order flow. Now, just really quick, delta, order flow delta, don't be confusing it with options delta, which is something completely different. In order flow, delta is the net difference between aggressive buyers in a bar and aggressive sellers in a bar. So generally, if a bar has negative delta, it's telling you aggressive sellers were in control of a bar. And conversely, generally if a bar has positive delta, aggressive buyers were in control of the bar. Now, sometimes it may deviate a little bit, but that's a whole nother presentation for another time. Now, imbalances, order flow imbalances are the result of aggressive trading in the two-way auction. Now, you can determine what you consider an imbalance, okay? I mean, the industry standard is 4-to-1. Some people use 3-to-1, some people use 5-to-1, some people use 10-to-1, 9.87-to-1. It's up to you. They said the industry standard is 4-to-1. 3-to-1 is also very nice. So when aggressive buyers outnumber aggressive sellers by a certain percentage, it's considered a buying imbalance, and it's going to be a blue number in the footprint. It's going to appear there. The volume will appear blue, as you can see. In this on these green bars here, you have buying imbalances. When aggressive sellers outnumber aggressive buyers by a certain percentage, is considered a selling imbalance, right? It's in the two-way auction, right? So you could see 123 traded on the bid versus 6 on the offer. That's more than 4 to 1. That's considered an imbalance. I have this chart set to 3 to 1. 273 against 70 is more than 3 to 1. 258 against 34 is also an imbalance, right? So you can see the red numbers generally are going to appear on down red candles, and generally buying imbalances are going to appear on green candles. And people say, well, if you got buying imbalances in green bars and selling imbalances in red bars, I don't need order flow. Well, when you get to lows of the day, right, you're always going to want to be looking for signs in the market that the the move down is over, right? I'm not trying to pick a low. I'm letting the market tell me the low has been made or the high has been made. I'm going to be looking for aggressive selling coming into the market. Okay. Now, when aggressive traders cause market imbalances, and there are multiple imbalances in bar, that tells you a market is out of balance. So, like I said, often bars have buying and selling imbalances, but when you see bars that have 1, 2, 3, 4 imbalances, 1, 2, 3 imbalances, especially when a bar has only 1, 2, 3, 4, 5, 6, 7 price levels, but literally half the bar is buying imbalances, what do you think that means, right? It means that aggressive sellers have finally stepped into the market, and you would expect the market to rally. Just as if you had a red bar, a down candle, with a lot of selling imbalances, it's telling you the aggressive selling is really strong and the market probably has more capacity to move down, right? And when a market is out of balance, that's often when vertical moves start because one side is in control of the market. But what I'm going to be focusing on today is imbalances. I'm not going to talk about delta today. I'm going to be talking about imbalances. So what do you see in these bars here? You have 3 green bars off this low here, off the swing low. You got a bar with 2 imbalances, 2 buying imbalances, a bar with 1, 2, 3, 4 buying imbalances, another bar with 1, 2, 3 buying imbalances. So the market has been selling off, it goes sideways. At this point, you should be asking, is there more potential for this market to go lower? Or is buying finally come in, and it looks like we're going to start a trend up, right? A reversal from this move down. That's where the order flow is going to help you. On a candlestick chart, this is the same chart right here. What you're seeing on this order flow chart is this chart, right? This normal candlestick chart. You just see the open, high, low, close, right? And people will say, well, yeah, we close lower than where we open. Obviously, sellers are in control. Okay, and they'll say, well, down here you got these pin bars. Well, here you had a pin bar, right? You had the same type of bar, right? The hammer formation, right? Market traded down and then buying came in, moved it back up, but then you just traded lower. Okay, maybe you took this trade, you got stopped out. But why should you take this trade if there's nothing in the order flow to tell you to be getting long? Just as here, if you're buying the next bar, your stop is right below the low, you just got ticked out, right? So you had 2 losing trades. But if you just wait for the order flow to tell you, aggressive buying is coming in, it came in on these 3 green bars, that was your sign. People say, well, you got a lot of red bars down and you got some green, you just buy it. Well, you had green bars earlier and you still went down. So, it's, trading is not complicated once you understand who's in control, if there's anybody in control. Sometimes, the market, there's no one side in control of the market. It's just doing what it's supposed to do. It's facilitating trade. People are trading. But with order flow, you can see without a doubt, right, when the market is exhibiting imbalances, right? Because you're analyzing what is being traded in the market, right? You can see the market's come down. You got the last couple selling imbalances right here. Then it's all buying imbalances. 2, 4, another 3. So you got 10 buying imbalances almost literally almost at every price level on the way back up, right? So at this point, you should, when we hit this 36.82 yesterday, that attracted buyers. People thought the market was cheap and came in with a vengeance and said, hey, you know what? This is a very good buying opportunity. And they came in and started buying, right? But that's E-minis. What about other markets? Here's crude oil yesterday, right? knowing areas of imbalance is going to help you. Again, you had this nice sell-off down to 47.25. It just sort of goes sideways in here. Market went up and it pulled back literally right to this level. Why? Because in here, where this arrow is pointing, there's buying imbalances. You can't see it on a normal candlestick chart. The information is just not available to you. So this is that area in that box right here, right? The bar. We got 4 buying imbalances. Okay, and even in some of these other bars preceding it, you've got a couple green candles with 2 buying imbalances, another 2 buying imbalances. So, buyers are being attracted, right? We just had a sell-off from 47.70 down to 47.30, a nice 40-cent move, okay? And then the market's sort of going sideways, but buyers are stepping into the market. You can see the nice aggressive buying, even in these red bars, you've got aggressive buyers stepping in. So what do you think the market's going to do? You think the market's going to go lower or go higher? Well, when you start seeing a lot of aggressive buying coming in, that's bullish for the market. It's really simple, right? It's not, you're not trying to build some spaceship here, right? This Japanese yen this morning, okay? Again, we hit the high and we sold off. People say, well, yeah, you hit the high, you got a red candle, you got to sell. Well, why didn't the market sell off from point A? Why point B and not point A? Well, if you look at an order flow chart, this is point A here, but point B, you got 1, 2, 3 selling imbalances. A couple bars later, you got a bar with 4 selling imbalances. Right? So, that's how you can tell when things have shifted in the market. You can see on the way up, you're seeing buying imbalances coming in. 1, 2, 3 here, 1 here. You're going up, you make the new high, you got some buying imbalances, but now selling imbalances coming in. Say you're not convinced at this high of the day that, you know what, it's kind of mixed here because you got 3 selling imbalances in this bar, but you got a buying imbalance. The previous bar had a buying balance, the other bar had 2 buying imbalances, and you had a couple buying imbalances. But by the time you get to the second bar, whack, right? The aggressive sellers just hit all the bids here. It's 36 against 4, 79 against 4, 37 against 4, 25 against 6. And again, this is the chart. And you can see the nice move from, the 96, 97 area on down to, the 96, 87 area. But I'll be honest, when the market's moving quickly, you're trying to digest everything that's happening, it's going to get very confusing. That's why I say let software help you. Let your trading software show you when aggressive buyers are stepping in at lows or aggressive sellers are coming out at highs. Your trading software should be able to show you where multiple imbalances are, and a lot don't. That's why I ended up creating my own software, is because, as a trader, I would look for this, but I was really limited to just, 2 markets max maybe, because there's a lot of stuff going on and you're trying to process this in real time. This, especially now the way these markets move, you're getting 20-point moves in, on a 1-minute bar in the NASDAQ. That's overwhelming, especially if you're trying to watch NASDAQ, trying to watch E-minis, mini Dow, throw in crude, and maybe 1 or 2 other markets. It's going to be very difficult. And if you're looking at a normal candlestick chart, you're not going to be able to see where these imbalances are, and you're going to miss these great trading opportunities, right? This is that low there, or that swing low here in this box right here, right? You're coming down, and you see these bars with multiple buying imbalances. Now, after it happens, at the end of the day, you look back on your chart and you could say, oh yeah, look at all these buying imbalances, I should have bought there. But when you're trading, it's very easy to overlook it, especially if you're on a position in one market. Your focus may be 95% on that one market, and you're going to be missing these other opportunities, right? That's why let the software highlight to you bars with multiple imbalances, right? That way you can see it, right? The mind processes images 10,000 times faster than it processes numbers or words, right? So what I had my software do, I've got a lot of tools for traders programmed into my Orderflows Trader software. One of them is this multiple imbalances tool to highlight, basically put a box around the bar telling me, hey, you know what, this bar, pay attention, idiot. This bar's got imbalances. multiple imbalances, just as this bar, this green bar, this other green bar has got a lot of multiple imbalances. And when I start to see them bunched together, then I know, right, that aggressive buying is coming into the market, right? On a move down like you have here, I'm not surprised to see multiple selling imbalances. The market's moving down. People are piling into the market. But when you hit a swing low or the low of the day, and all of a sudden you see multiple buying imbalances coming in, over a series of bars, that's a sign. That's a sign that, what, aggressive traders are coming into the market. This is a very good low risk trading opportunity because you can join in the bigger traders, right? The bigger traders are the ones that are going to move the market. And when they're aggressive, that's who you want to be trading alongside. So when you're trading live and the market's moving, it's easy to overlook one little piece of information, such as bars with multiple imbalances. That's why I created the Orderflows Trader software, my software I use in my trading, to show me situations like multiple imbalances. That way it's easier to follow multiple markets, right? This is that move in the E-minis, right? If I might have you can very easily miss a move like this right off the low, swing low, for a nice, 10-point move up. So when you're trading on the side of aggressive traders, right, you're trading in sync with the market. That's what you want to do. Markets move up because of aggressive buying. Markets move lower because of aggressive selling. Don't try to beat the aggressive traders. Join them. Don't be the fish swimming upstream that you're trying to jump. Bears know. They know that when these fish start swimming upstream, all they got to do is just sit there with their mouth open, right, and catch them. Don't be that fish trying to swim upstream. Be the guy on the bull that's what I care about. That's joining in. The bull's going to move. He's going to run in a direction. You just sit on him and enjoy the ride. Again, this is the Japanese yen yesterday, right? How can you determine aggressive trading on a candlestick chart? Well, answer, you can't. You can't without looking at the order flow, right? You're seeing it right there. It's clear as day, but if you have, maybe you can catch it on a chart like this. Maybe you can see it. Maybe you trained yourself to see it, but it's just better to have a software that says, hey, you know what? You've got multiple imbalances appearing right here at the high of the day. Then you look and you put two and two together and oh, you know what? I'm at the high of the day. I got multiple selling imbalances. This is probably a high that's going to hold for now. And you take the short. Crude oil yesterday, right? You're coming down, big 40-cent move down. And then you see, again, if you have trained yourself to look at it, look for it, maybe you could pick it up in real time when you're looking at 4 or 5 other markets, and doing your other things, answering emails or whatever when you're trading. Maybe not. Maybe you can, maybe you can't. But if you have a software that says, hey, you know what? You got multiple imbalances appearing here, at, at this, after this 40-cent move down, all of a sudden you got multiple buying imbalances. Hey, you know what? That's probably a trade you might want to take. Now, I'll give you a word of caution. Okay. Don't run out and trade every bar with multiple imbalances. You got to put everything you see in the market in context. A lot of people will listen to a presentation like this up till now and say, oh, all I got to do is look for multiple imbalances. Well, part of trading the way I view it is a puzzle, okay? And you're always trying to put the pieces of the puzzle together, okay? And that's where market context comes in. Just as if you're doing a regular puzzle, right, with the pieces, you can't put a piece for the side in the middle or a piece from the middle on the side, right? That's what's called market context. So, for example, this is MNQ, right? Micro NASDAQ. And market context is, where do you want to be buying? Where do you want to be selling? Well, on a move down, do you want to be selling at point A or point B? You just had a move down. Actually, the point A should be a little bit higher here. But you don't want to be selling after a big move down. What you want to be doing is looking for a point like C, right? After a move down, you want to be looking for the aggressive buying. Just as after a move up, you don't necessarily want to be buying at point D. Maybe you could always add on, at various levels on the move up if you got bars with multiple imbalances. There's nothing wrong with that. I do that. But the better entry is going to be at the swing low rather than after a move up. And you know what? The market gives you many opportunities. If you miss a trade, don't panic. Don't say, oh, you know what? I missed getting short at A. I'm going to get short at B. Well, no, just wait for a better opportunity. And sure enough, it came 2 bars later in point C, this time a long trade, right? You miss C, don't necessarily think you got to get long at D. You just wait for, when the market makes a new high, a swing high to get short and with multiple imbalances. This was yesterday in the cash open in the E-minis. This yellow area on the left is the cash open. Okay, market just went sideways. Then what do you see? All of a sudden, you're starting to see the aggressive selling come into the market. You got a bar with 3 imbalances here, another bar with 2 imbalances, another bar with another 2. And then as you start breaking down, more selling imbalances. So your first sign that maybe this move was going to be going lower was this first bar, at E33 that had multiple selling imbalances, but you're still going sideways. Then finally, when it sort of breaks out of this low area of the first 5 minutes, boom, as you're breaking out, multiple selling imbalances, and the market proceeded to go down into the, down to what, 82 or so. This is bonds yesterday, right? This is a 4-range chart. Point A is the first low of the day. But if just because you hit the low of the day and you got a green bar, doesn't automatically mean the market's going to reverse and start trading higher. For a market to start moving higher, you need aggressive buyers to come in. Not just one bar where, it closed higher than where it opened. Then, bar B, the bar that precedes bar B, this one right here at 803, it's actually when the low was made. But the next bar after the low is screaming at you saying, hey, aggressive buyers are coming into this market, right? What do you want to do? Right? Do you think this market's going to go down? Well, there's a chance. There's always a chance of anything happening in the market, but the way to position yourself is for a move up, right? And you started moving up, and you can see you even hit this red bar where you've got 2 buying imbalances. Okay, market closed down. Okay, well, what do you make of that? All right, well, you got some aggressive buying. Well, you got to watch to see what's going to happen. One, that could be supply, people offering it out, but the aggressive buying is quite strong. You got to watch what happens in the next bar. More aggressive buying coming in, 27 against 586. Obviously, we took out this high of this red bar with buying imbalance, another buying imbalance, and again, it just moves higher. This is wheat yesterday. So I showed you crude oil, I've showed you Japanese yen, I've showed you micro Nasdaq, I've showed you E-minis, wheat, because and this is just yesterday, right? So while patterns and order flow repeats in the market, they don't repeat identically. Every market is slightly unique, but once you understand order flow, you can apply it to any market. This is wheat. There's a nice 5-cent move right up off the low. You made 3 lows here, A, B, and C, right? A, B, and C. Well, if you bought A, you get stopped out. Again, I'm not trying to pick the lows, right? I'm always looking for a reason to buy a low, right? I'm not trying to predict the low. Oh, but if we hit a low, maybe I should start buying it. We got a green bar. No. Bar B, level B, yeah, it went up, just went sideways and hit the new low at C. But at C, in this area of this low, this is where the aggressive traders finally came in, caused the market imbalance to occur, and the market started rallying, right? You can see this is the low of the day right here in this green bar, but in this bar right here at 1044, you got 3 buying imbalances. 2 bars, 3 bars later, 4 bars later, you got another 3 buying imbalances coming in. Even in this other bar, it's kind of mixed, 2 selling, 2 buying. This one's got a buying imbalance, but you're not seeing a lot of selling imbalances coming in. Sure, there's selling. There's always buying and selling going on in the market, but what you're looking for is when aggressive buyers are in such force, so to speak, that it's causing the market to go out of balance, that the market is going to start moving, right, directionally, right? So hopefully by now you can see how simple it is to reduce when you reduce the market to the basics, right? You're not trying to, oh, you know what, we just had this move down. I got a green bar. I got to buy. Oh, you know, shucks, I got stopped out. There's a couple more green bars. Maybe this is the low, you know, or, you know, hey, we finally hit a low. Finally, you know, once, twice. Well, third time's got to be the charm. I got to buy it. Let the market tell you aggressive buyers are coming into the market or aggressive sellers are present in the market, right? The market gives you a lot of information. It's whether you want to use it or not. If you're just looking at a normal chart, normal candlestick or bar chart, it's just giving you the open, high, low, close. And again, you know, some people will say, well, I don't need order flow because, yeah, it's, you know, any fool can see that you got a big red bar down, sellers are in control. Yeah, but you don't see the big red bar down until after the bar is closed. Okay, it starts out as a small red bar, gets a little bigger, then so, oh my gosh, yeah, it's a big red bar, sellers must be in control. Well, okay, it goes down, sellers are in control, but it hits the low. At some point, the market's going to bottom out. And what order flow is going to help is it's going to tell you that the aggressive buyers are in control, right? Just as, you know, here in the bonds. Yeah, we've been trading down, down, down. We hit a low, bounced up, hit another low, but now the aggressive buyers came in, right, and quite strong. You know, 1,917, 653, you know, 158 is not that strong, but, you know, the 1900 right off the low is pretty strong. You know, it's telling me that, you know, there was a lot of sellers here and the buyers ate through it. You know, there was almost 2,000 contracts on the offer here at '08, but buyers were, you know, damn the torpedoes. You know, this is a great buying opportunity. You know, I'll buy everything you have. You know, offer me more at this price because at this price, I know it's a great deal. I think the market's going to go higher. And sure enough, the market went higher. You know, just like, again, if a market is going sideways, markets make moves that go up, down, they go sideways, right? So, you know, after a move up, oftentimes the market goes sideways. After a move down, market often goes sideways. Excuse me. You know, at cash open, you know, important times of the day, you know, cash open is an important time of the day for trading equities. You know, market's trying to find its footing. You know, you know, which way is the order book leaning towards at this time? You know, is it buying or is it selling? And you can see early on, it was telling you, you know what, it's kind of going sideways, but it's slanted more towards selling. Okay, great. You know what, I could take a nice low risk trade. You know, if I'm getting short here at 87, 88, where's my risk? It's just back into 90. You know, you're risking a couple points to capture, you know, maybe, you know, at least 1 to 1, hopefully 2 to 1, maybe 3 to 1 here, right? It's like I said, it's the market's speaking to you. The market's telling you what to do. You know, it's like, hey, there's all this aggressive trading going on, all either aggressive buying or aggressive selling. Do something about it. Okay. So, like I said, when you talking about market context, when you're at highs of the days or swing highs, look for aggressive sellers. When you're at the low of the day or swing lows, look for aggressive buyers. Look for that potential reversal in the market, right? But you got to look for that at certain points in the market. So this past 40 minutes or so, hopefully you'll agree it's been time well spent. You know, honestly, I can't cover everything in a 40-minute or 60-minute training session, but hopefully by now you should understand the importance of aggressive buyers and the importance of imbalances in the market. So I've got a special offer so you can get everything you need to know about order flow. And if you act fast, I'll give you a very special deal. You know, the charts I showed you are generated from my Orderflows Trader software, which runs on NinjaTrader 8. You know, I'm a futures trader. I've always been a futures trader. NinjaTrader 8 works fine for futures trading. I've used it for, gosh, I don't know how many years now, 8 years, more or less. And it works, it's stable, right? I don't really have any issues. You know, yeah, recently, you know, a lot of these trading platforms, as the market's been making new highs, they've been locking out people. You know, people can't access their account. Honestly, I've never had that problem with NinjaTrader. I think in the past 8 years, I've had one problem where something happened in the euro currency market moved fast. My old computer I was trading on locked up. Okay, that was it. You know, honestly, in 8 years to have one major issue is nothing. So, people ask, does it work on TradeStation or TOS, Trade8? No, it doesn't. Right now, it works on NinjaTrader 8. And what it is the volume footprint chart that you see in this presentation with, I showed you multiple imbalances in the bar, right? Putting the box around it, something simple. There's 17 total order flow related tools in the Orderflows Trader, okay? Rather than just having the normal footprint, the tools are like going to tell you when there's a potential sweep in the market, when there's market weakness, and, obviously imbalances, and there's different types of imbalances, value areas. It just really gives you a lot of information from the market. It's really easy to set up. It takes 2 minutes. If you're familiar with NinjaTrader, you're familiar with how easy it is to set up an indicator. Orderflows Trader is an add-on. You don't even need any templates because once you load it and install it, that's the settings. The default is literally the charts that I have up on the screen here. And normally I sell it for $8.99. And really what it is, the Orderflows Trader takes my knowledge of order flow trading and puts it into a program so you can see what the big traders are doing in the market. But having software is one thing, right? You got to know how to use it. So I'm going to give you my order flows trading course for free. And I sell this for $2.97 every day on my website. But I'll also give you advanced training with the Order Flows Inner Circle video series. It's not available to the trading public, right? To get it, it costs $500. It's 56 videos on advanced order flows, tricks, tips, and analysis. So when you add the software, the training, and the Inner Circle video series, that's already almost $1,700. But I realize it's one thing to learn from videos and books, but that's hard for a lot of people. It takes discipline and commitment. What I found is it's much easier for people to learn in a live classroom session. So for the past 2 years, I've already got over, there's already every week on Tuesday nights, I do a live training session where you can come in, ask questions. I talk about what's happening in the market, whether you got a question about the software, about the market, about a tool. That's where you can ask and interact with me, every week. There's already 102 sessions. If you can't attend, you get the recordings. This is the recording area. Some people charge up to $200 a month for training. For what? You're buying the software, you should get it for free. But for just a one-time payment of $749, go to orderflows.com/oft3, and that will take you to the page where you can, proceed with getting started with order flows. But a special bonus for investor inspiration, I've got an extra bonus, the order flow playbook. Normally I sell it for $297. You're going to get it for free. So go to orderflows.com. Page looks like this. Scroll down, get here, click on buy now. Click that button to get started. Takes you to PayPal. I don't get your information. PayPal processes everything. And it's just a one-time payment of $749. So you're going to get the Orderflows Trader software, the trading course, the Inner Circle video series, access to the weekly live group training, the Orderflows playbook. Now, if you stuck around, want a copy of my book, go to orderflows.com/book.html. And it'll take you to this page. You got to enter your name and email. And after you hit submit, it'll take you to the download page so you can download that book. So getting started is easy. You just got to get up off your butt, type in this URL, www.orderflows.com/oft3.html. The link is in the chat. There's no recurring payments or other payments in the future. Upgrades are free. We've done 3 upgrades already. Well, sorry, 2 upgrades. Original version was Orderflows, then there was Orderflows 2. Now we're on Orderflows 3. It's free, right? The only payments you need to do is to NinjaTrader for their platform, but it will work on the free platform and your data fees, and that's it. So thanks, just get started. Thanks for attending today's presentation. Anna, I think I'm exhausted my time. Everyone, I've put the information, the links in the chat for downloading the book, as well as getting started with Orderflows software. So thanks, Anna. I'll throw it back to you.
This is David Smith for the Morgan Report. Happy to be here with you today. The markets are very active today, and we're going to have some exciting information to cover right up to date. I've got a few slides this morning that I actually put together within the last hour. We have an opportunity to make massive profits with calculated risks, and I think this is going to be some of the most exciting trading that you're going to see maybe in our lifetimes. Little disclaimer here. Be sure to do your own due diligence. I'm not giving investing advice. I'm giving ideas that I have worked on and that I think work for me and that may work for others. It could help inform you before you make your own decisions. These are the assumptions we'll be covering today, that this is the third inning of a once-in-a-lifetime run in the metals, miners, and blockchain, that proven strategies can put you in the winner's circle over the next few years, that money investors will leave the market too soon and leave a lot of money on the table. Some of them will actually try to get back in near the top. Many more will overstay and give back everything they've accumulated. They'll do a round turn. You can plan ahead to minimize the risk of all this and maximize your gains against this sort of thing happening to you. There are two things that you absolutely cannot afford to lose: your psychological capital, which will take you out of the game if you have $1 million trading account, but if you are psychologically impaired from overtrading or FOMO situation, you will just drive your capital into the ground. You must maintain speculative investable funds so that you have something to work with. And through this, you must be bold, but you must be right. So you're balancing risk reward constantly. You're trying to remain calm. Everything has been changing due to COVID. Nothing is really the same. Plus, we were going to have paradigm shifts anyway with the shifts in the metals and miners and green energy and all this. So all of this into the mix makes for a very chaotic situation that we are all striving to remain a certain amount of quietude in as we trade and as we establish enter and exit positions. These are the survival tactics that I think will give you the best chance to get through this, make and keep quite a bit of money, and also keep your sanity. It's important that you make money, not exactly how much. It's okay to sell high and buy back higher. I did this a few days ago on a uranium position that I had. It was my biggest position. I sold a third of it. I realized at the end of the day it was an incorrect thing to do. I bought it back 15% higher the next day. It's 30% higher than that is now. So sometimes you have to suck it up and get back in if you think you've made a mistake. It's important, and this is what I should have done, to be right and sit tight, especially in the early times of a bull run, and not go trading your core positions. We all make these mistakes. I'll keep making them in the future, hopefully less than I did before. The market can stay overbought for a long time, so don't worry too much about that when you see some of these things coming up. Also, don't wait for the market to tell you what to do before you act, because that means a lot of other people have already figured it out, and the profit potential for you and the risk will be increased as the profit potential decreases because of that. There are several free copies that are available to you if you'd like to write into the morganreport.com/myfeereports. I'll be referencing them when I talk today. All you have to do is write in and ask for them. They'll come to you in a PDF form, one that's available just within the last few days that I'll discuss a little bit later. A lot of people are going to be left behind because they waited for clarity before they acted, or they had too many scenarios in mind and they sat there and didn't execute the plan that they had already put together that probably would have worked for them. And hopefully you will not be one of these people. The first thing that David Morgan recommends in the Morgan Report is to get some physical. And that sort of thing is drying up as we talk because more and more people are buying physical, and that should be your insurance. You will probably make money on it, but you're not buying it to make the money. You're buying it to protect your other assets, which will decline in value through inflation, government confiscation, this sort of thing, and chaotic situation in the social structure politically as well. Whereas buying some metal and holding on to it will be your lifeboat. It's saved people's lives literally in the past. Over thousands of years, it will do it again. So acquire some physical, avoid the designer coins, avoid the graded coins, get physical close to the spot price as you can. Here's how tiny the gold mining industry is compared even to Facebook and Amazon, and certainly compared to the debt outstanding of the Treasury. So you can see as Doug Casey likes to say, when people rush into this industry, which they're starting to do now, it'll be like trying to squeeze the contents of the Hoover Dam through a garden hose. We're already seeing some of that as some of these stocks jump massively from day to day. And they also have volatility, so they can drop a lot too, not for any particular reason. So you don't want to be scared out of your positions. Research properly, take positions that make sense to you in your circumstance, and hang on with your core. Here you can see something that I think a lot of people are missing. A lot of money being put into circulation doesn't necessarily cause inflation. It's how fast the money turns. It's velocity. We're starting to see velocity where people are spending their money not because they want to, but because they have to. And food prices are starting to go up along with a lot of other things. People are starting to realize that, and this is what's going to cause inflation to rise, I believe, much faster and much more profoundly than what the market believes right now. They're just starting to get a hint of that, and that's why gold and silver are making new intermediate highs as we speak. The Canadian advantage, about 2/3 of the mining stocks start out as Canadian companies. And so the Canadians have a certain advantage in getting this information ahead of people, say, in Europe or in the United States, but it's still available. You just need to know where to look for it and how to access it. Hopefully, the brokerage firm that you have will enable you to trade Canadian stocks. Sometimes you can buy them before they get a US listing. I've done that half a dozen times this year alone. Most of the ones that I bought are up substantially, and then I added more when they got a US listing. I've learned this the hard way by missing one of the biggest runs in my career about 15 years ago, which was Aurelian, which went from 55 cents to $42. I was looking to buy it at under $1, but didn't think I could buy it if it was not listed on the US exchange. I've since learned from that mistake, and I'm now applying that in my trading. The thing is to copy what others are doing, not just to buy their stocks, but learn how they think. And if you can do that, you can end up becoming just as successful as they are in their own rights by learning how to spot some of these companies before the rest of the market does, take a position when it's quiet, and then sell into a big profit. I would suggest that you Google Eric Sprott and Mark O.D. to find two people who, in their own way, are massively successful because of the way they think, the way they plan, the way they act. Again, learn how they think, not just try to learn what they buy. David Morgan and I co-authored this book, Second Chance, How to Make and Keep Money from it's in play now, motherlode of all gold and silver shockwaves. We're in this opportunity now. It's still a bit early days, but this book tells you not only how to make the big money, but to keep it. I don't know of any other book that does this. It accords with human nature so that you don't give it all back at the end, which many people will. The idea is for you to reach a place where your mind is like the water, misu no kokoro, the Japanese call it, where the reflection of the market is reflected in your attitude and your ability to execute, and so that you do so with a minimal amount of emotion. When you execute, do so like Miyamoto Musashi, Japan's sword saint. Think only of the cut. Try to get as much emotion as possible out of your trading. You never get all of it out, none of us do, but don't do the fear of missing out, the FOMO situation. When you find yourself getting into that mode, like if you're chasing Bitcoin this morning, step back and ask yourself, is this going to help me out, or am I buying just before a big break? I believe that the supply-demand, what I call the subduction zone for the metals, especially gold, silver, and copper, and now even base metals with the green revolution of electric vehicles, with nickel, and don't forget that uranium is a metal. All of these are going to move into a bull market that will start with the gold and silver, but eventually it's going to be synchronized with the base metals. And it's not going to take 5 years to happen. It's going to flow, I think, more quickly than most people believe. In the volcanic subduction zone, you have a certain part of a plate thrusting underneath the other plate, creating great tension. And so this top plate is what I would call conceptually supply, but the demand is thrusting underneath it, creating tension, and eventually will cause a price explosion as supply dries up and demand overwhelms it. You can see silver, what's happened to silver over the years. The yield at the head grade is down 50% in the top primary silver producing mines, of which there are less than 24 globally, because most silver comes from base metal production of copper, zinc, and lead. But the yields are dropping, so they're digging more ore out of the ground in order to get the same amount of silver. And you can see the Asian silver demand vacuum cleaner, which has kept sucking up the silver and the gold in spite of COVID this year. As Dr. Peter McGaw, one of the sharpest tools in the silver shed, talks about it, when the price of silver moves, you can't ratchet up production from the world's largest mines. The only place to pick it up on the slack side is in the few primary silver mines, which will quickly be overwhelmed as this massive bull run gets underway. Here's what's happened the last few years. Silver yields have been declining across the globe, even as industrial and investment demand has been surging. Here's some ratios for gold and silver. If we see a 60-to-1 ratio for $10,000 gold, we could see $166 per ounce silver. 50-to-1, 200 per ounce. Even if you divide these numbers in half and you talk $5,000 gold, we could see very, very high prices, all-time highs into 3 digits, which I think, and which David Morgan also believes, we will see $100 plus silver before this run is over, perhaps substantially beyond that. Here are prices taken this morning. You can see the huge move up, still within a massive congestion range, but indicating that silver and gold may be attempting to break out into new highs from where they've traded over the last 4 or 5 months. This may or may not be successful in December, but it indicates that you don't want to be left behind, and a move above $26 silver would indicate a possibility, if not a probability, of a breakout above $30 silver. Once this happens, we could see another $8 to $10 on the silver price in very short order into early next year. Here's what I call the Bitcoinization of the silver supply. This is a conceptual idea. Bitcoin was not supposed to trade above 20,000 for quite a while. All of a sudden, it's at 22,000. It's actually around 23,000 as I'm speaking this morning. All this happened, $3,000 a Bitcoin has happened within the last couple of weeks. It turns out that all the Bitcoin that's being mined at about 900 coins a day by the miners has been sucked up by just 2 companies. That means that any Bitcoin bought has to be bought from somebody else that already owns it. I think a similar thing is going to happen to silver in the demand as the investors suck up what is out there, and then the price is going to rocket higher. You can see what happened this morning. German retailers are seeing a run on gold and silver just because of an announced nationwide shutdown due to COVID. All sorts of reasons are going to startle people into buying more gold and silver as the premiums rise, the supply decreases, and the prices rise for the metal. I call $26 to $49 silver volcanic tremors. That's what we're seeing right now. When silver gets above $50, we're going to see a pyroclastic eruption, just like Mount St. Helens exploded, not from the top, but blew out the side of the mountain, covering several states in ash and killing the number of people that didn't expect a sideways explosion. This is what's going to happen to silver. It's going to explode above $50. I wrote this article last week. It's posted on Money Metals. You can, if you don't know about crossing the Rubicon, what that means, you can read this article. It's available free from the Morgan Report. And that link didn't get finished out. It should be the morganreport.com. And you can also Google what crossing the Rubicon means. It's a point beyond which you cannot return, and I think silver is set to do this, perhaps not in the next week, but sometime soon, perhaps sooner than we think, possibly as early as next year. When those price points are exceeded, silver will not be going back to a lower price that we've seen for many, many years anytime soon. Here is what Morris Hubbard has indicated, the cup and handle formation, a very reliable, takes a long time to form, set up for gold, which targets $4,000 gold and probably substantially higher than that over time. Here we have the difference between the gold that we can see put into ETFs and the gold that is going into other areas such as holes in the ground. And we need to figure out where that's going. I can tell you one thing, that's going to be sticky gold. It's not going to be turned around and sold into the market anytime soon. This is one of 3 mining stock investment tailwinds that I believe will give people outsized gains in relationship to what they have done in the past in mining stocks, which have underperformed gold for a number of years. They are now breaking out, and mining stocks should outperform gold due to the fact that they are riskier, and that's exactly what they're doing. So you accept greater risk in order to get greater returns. That's not been the case for a long time, but now that's changing, and I believe will continue to change in a big way. Here you see another gap within this concept. The juniors have been underperforming the seniors. That's hugely the case, and normally they move fairly close together. So if you buy a quality junior mining producer over the next couple years, I believe you will make substantially more on a percentage basis on your money than buying a quality senior. You will accept a little more risk to do that, but the potential reward is greater. Here you have the spot gold ratio versus the miner X. Look how out of kilter it is. Arguably, it's been out of kilter for 48 years. It's now going to change. Look how long it took for this bear market to work itself out from 2011 into the false start in 2016 and finally died a death here in late 2018. We're now in a new bull run for the metals and miners. This is the most asymmetric gold stocks versus gold trade of our lifetime. You do not want to miss it. Here we are just getting started. You can see the little yellow line there. We got a long ways to go in terms of time and potential profit. Do not make the mistake that many people did with palladium, and I actually made this mistake too. When you can see here in 2018, when it drove above $1,000 for the first time in 19 years and then dropped, everybody thought, myself included, that that would probably be it. That was the end of the bull market in palladium. After feeling like a hero for a while, I realized I'd made a big mistake when it went up to $1,200 and then shot up to $2,800. Even today, it's still around $2,300. I think a similar thing is going to happen to silver. You can choose the price point. At some point, we'll think the top is in. It might be $100. It might be $150. It might be $200. It'll drop to $150 or $140. Everybody will see about selling out, and then it'll rise to $300. I think that sort of thing is very possible with silver. The same concept that we saw with palladium. Try not to let that happen to you. Our book helps you to avoid that sort of thing with what we call the sacrifice throw portfolio in our Second Chance book. David Morgan has stated and done research that as much as 90% of the profit potential comes during the last 10% in time of the bull run. Do not forget this as we get into these stratospheric prices. This was stated by Incrementum, and you need to remember it. When you think it's all over, the trend will probably run another 9 months and double the price from where it is. You want to capture at least some of that. Don't be left standing at the curb completely sold out. There's a way to avoid it. And also, you don't want to be standing there completely all in either. You need to find that balance to capture as much profit and hold on to it as possible. This is something that changed my thinking in one of the biggest ways in recent years when I listened to a rare interview by Peter Groskopf of CEO Sprott. He mentioned something that I knew about but hadn't thought about it in the way he said it. We all are aware of the Pareto principle, where with any task, 20% of your effort will give you 80% of the returns. This can also be applied to the mining stock. After he said this, I went back and looked at my own stocks that I had, and sure enough, about 20% of the ones that I held out of about 25 or 30 stocks were the ones that were doing the best for me and that I believe would give me the biggest returns. Now, I approach this differently than some people would because I was willing to accept more risk. I actually overweighted the ones that I thought were going to be by 20 percenters by the Pareto principle positioning, and those things are up largely for me now beyond anything else that I have. So I believe that this is going to supercharge my profits. You might want to approach it a different way, but consider that most of your stocks will not give you the majority of the gains. A few will. Try to identify them carefully and carefully hold on to them as core positions so that you maximize your potential gains. I have an article I wrote for Prospector News a couple of months ago, 4 Best of Breed Mining Geologists. You can follow their work by getting into their head and seeing their thinking, not necessarily what they're buying, but how they approach it. And that can help you become a very increasingly successful trader. This is also available to you as a free report from the Morgan Report. I've got a uranium campaign, which I wrote about for the Morgan Report last spring. It now seems to be being activated over the last couple of weeks. I'm approaching it differently than some people might, and some of our subscribers may or may not have decided to do it the same way. I look at it as a secondary focus. My primary focus will remain the gold, silver, and mining stocks, but I also believe a fair amount of money can be made in uranium after this huge bear market, which has taken out companies to the point that there were 600 companies at the end of the 2011 bull run in uranium. There are now only a few dozen. And that means that you have a good chance of picking a few that will be good companies. Almost all of them should do well, but some will do extremely well. I've chosen just a handful, 3 or 4 companies and situations that I have put a certain amount of, quote, small money in. And I don't expect this market to last as long as the last one. I could be wrong, but I'm not going to be there anyway. I'm going to play the boom phase where the initial convulsive run to an intermediate top takes place. It could be $90 uranium. It could be 120. It could be 60. Wherever I think the easy money is being made, I'm going to sell most of my stocks into that huge rise, into big strength. I'm going to hold a small position for the possibility of being wrong and have it go up a lot more than I thought. And this is discussed fully in the STP portfolio in our Second Chance book. I've also been able to make some of these positions pay by doing a little bit of trading, and now I'm sitting tight as some of my best trades are going up by very large percentages almost on a daily basis. Here you can see a tell that gave us an indication that the bull run was getting ready to start in uranium late this year or early next year because the spot price is moving above the long-term uranium price that the users pay to make sure they have enough uranium for their units. And I think that with Kazatomprom and with Cameco being the 2 biggest sellers of physical uranium going into the market to buy for their own needs, this is a very important tell that indicates that the uranium market is becoming very unstable in terms of a supply-demand situation, and that we could see very strong upside in the quality choices after you've done your own due diligence by putting small money in to make big money, an asymmetric trade. I hold 2 of these companies that are discussed here, Encore Energy and EnviroLeach, and I believe that these are 2 very strong players in this market, especially the Encore Energy, which is recovery of uranium. EnviroLeach is recovery of e-waste products. Both of these, I believe, are set to change the landscape for these concepts, and you might want to look into them. I do hold both of them. There's another major thing that's going on right as we're discussing, and that is that there are almost 3 billion people that are unbanked. They don't have a bank account, and that doesn't bother them because they use their cell phone for their bank account, and we're having a massive change to blockchain technology, which means you may not need a bank account in the future, certainly not in the traditional way that we have been seeing this sort of thing take place, where you have a bank account that now pays almost no interest, charges you a lot of bank fees, is able to literally keep you from getting your money out if you want it, if they decide that they have a bank run and they let you take out a small amount every month. They charge you a lot of fees. They take a long time to do anything. Blockchain is changing all of that. There are perhaps as many as 80 to 100 attempts to digitalize gold and silver on the blockchain. There are two that I feel have enormous potential. We've reported on the Sprott Vault Chain Gold and Silver in earlier reports last year and early this year for the Morgan Report readers. This is a very different product from the one that we've also followed. It has its own advantages and disadvantages. We're following one that we have been exponents of for almost 4 years, and that is the Load Cryptographic Silver and now Gold project that digitalizes gold and silver and puts it on cryptographic coins and tokens. They can be owned, they can be held, they can be spent. And this company is now de-risking itself massively by getting all sorts of approval through different regulatory agencies, including the United States, to expand its operations. It's something that we believe in. We are holders of it. We were early investors, and we are continuing to invest in this concept. And I could be wrong on this, but here's my view. I think that's one of the things that is going to happen is that the silver physical is going to dry up to the point that people wanting to get silver to not necessarily just spend it, but they can, but hold it, are going to be forced into a digital space like the Load project to purchase digital silver and have it stored in a vault securely in different places in the world for them until they decide to redeem it or spend it, and do it in a way that also has a premium that makes sense. Right now, the physical supply is drying up for traditional sources, and I think at some point, this type of a concept could be one of the last remaining and most durable ways for people to acquire silver and have it back digitally. Private, high-speed, peer-to-peer, silver, gold, and money for everyone. Literally anywhere in the world, potentially, this is going to become available. I believe that we have a series of things going on that are concomitant with each other, and they blend into each other in ways that are going to cause massive price explosions for gold, silver, and miners, for the blockchain concept. And we have everybody in the world looking at this at the same time. This has never happened simultaneously before. It's going to mean prices that we cannot even predict. It's going to mean volatility that's massive, that if you're not careful and you try to do leverage, could take you out. You need to be careful. It offers so much potential that is asymmetric in all of these respects. You don't need to put your house mortgage into any of these things to make a lot of money. You need to put a small amount of money in after carefully researching a concept, and then hang on, and then don't overstay your welcome, because these cycles could end up being shorter than we expect. And David Morgan has told his readers he's very good at picking tops, not so good at picking bottoms. He's going to tell his readers when he believes it's time to get out of gold, silver, and the miners. That's probably several years out, but that's one of the many benefits of being a subscriber to the Morgan Report. This is going to be put into hyperdrive by digitalized gold and silver and by blockchain enabled banks, which are changing finances across the board, how to send money, how to store it, and you need to owe it to yourself to become conversant on these concepts. Gold and silver is being reestablished as honest money. This is going to cause a demand factor, I believe, the third tailwind for gold and silver, which is going to suck up a lot of physical demand and cause the mining shares, which will become massively more profitable, to do moonshots in their own right. Here is what I would suggest that you look at some of these things. Look at Raoul Paul's Real Vision. He has a lot of free content here. You can become a subscriber as well. Learn about the blockchain space because it's changing everything. You can't just turn it on tomorrow and become a blockchain expert. You need to spend a lot of time learning about it. It's a layered information process, which some of us have been going through for years and we continue to do. Read George Gilder's book, how it's going to change things that are stable today. Make sure that you understand these concepts. Look at this. There are many good documentaries on blockchain and Bitcoin, and anything that's not Bitcoin is called an altcoin. Learn about these things and see about getting your feet wet. We're going to profile a blockchain-enabled bank next month in the Mortgage Report, where you can actually place US dollars or British pounds or Japanese yen into a regular bank account, turn it into their stable coin, and they will pay you interest in any way that you would like. Bitcoin, Ethereum, US dollars, if you're naive. And instead of getting a fraction of a percent a year, you can be making good percentage in being paid in something that is an appreciating asset, such as Bitcoin or Ethereum. So this will be a very exciting addition to our reader understanding base coming up in the next month or so. And we're going to interview a couple people who brought this revolutionary change out to make it available for all of us. Copper is going to be into a massive, massive bull market going forward. The EV revolution and the energy, the green energy, is going to demand massive amounts of copper, nickel, etc., silver as well. And this is a huge, huge deposit that is being delineated out in Ecuador. Look at the quality of this copper. It doesn't even need to be sent to a smelter. It can actually be processed into copper plate in situ. This is one of several big projects that could redefine the copper supply demand situation, which is not going to be addressed for a number of years. But these projects are some of the very few that have a chance to make investors a lot of money if they invest wisely. You can see what the Morgan Report has to offer by going to either David's subscriber base at themorganreport.com or a free weekly letter that he writes, and find out how you can become involved. I've been working with David now for almost 2 decades. I'm privileged and proud to be doing there. I think we offer as much, if not more, benefit for subscribers than anybody out there, and we really, really want to do the best we can for you. You can get involved with this by going right to your cell phone and doing these types of things to get an idea of what the Morgan Report has to offer. I hope this has been beneficial for you. You know, you don't need to stay in for the whole time that this goes on. I knew a Canadian sandwich trader who bought silver at $11 in 1979 and sold it at $18 when his charts experienced a failure. He made millions of dollars and never gave away a penny of that. He kept it all. So I'm sure he might have wished he'd stayed longer, but the point is he didn't overstay his welcome. He didn't ride at the 50 and down to $5, which is where it went some years later. So don't be greedy, but be conversant about getting knowledgeable and learn how to make big money and keep it as we move into something that can make life-altering changes for you with a certain amount of risk. You have to accept the risk. If you aren't willing to accept the risk, you cannot achieve the reward. Just try to make them balance each other out a little bit as best you can. And learn from this by following the 321 memory law, where you don't wait 2 weeks to think about what you've learned today, but you've hopefully taken some notes, you've done some research, you've looked at a couple of companies that I mentioned that may intrigue you. These are your own responsibility. And then when you found them out, that you put a certain amount in. You don't go whole hog on any particular one, even though you think it's a guarantee. And if you do that, if you're careful and you adjust your plan to your own circumstances, risk reward, emotional stability, and financial ability, things like this, you can become in a situation where you make life-altering changes financially on the upside while you migrate carefully through the massive, massive risks that all of us are going to have to be facing in the coming years, because those rewards are out there. And I wish that every one of you are able to maximize exactly what you're able to accomplish. I'm going to be trying to doing the same thing for myself. So thank you very, very much. I've really enjoyed speaking with you today. I believe there may be a little time for Q&A. I'll be happy to try to answer some questions for you. This has been David Smith for the Morgan Report. Thank you for having me on and giving me the opportunity to speak with you today.
Thank you so much, David. Great presentation. We have a couple of questions. Kenneth asking, can you show the slide of the mobile number again? Thank you.
So, show which slide?
With the mobile number.
The Morgan Report slide?
Kenneth, what number are you talking about?
What was the topic about on the slide?
Mobile telephone.
Oh, okay. Let me see here. You know, this is being recorded, I believe, and I think your audience will have an opportunity to access this whole presentation, correct?
Yes, correct.
All right. I'll try not to spin people's heads here. I think this is the one you're talking about, the digital gold and silver. And this is, go to low.one or agxpay.com to learn more about that. They're actually doing, they're going to be doing a bond raise here very soon for people, and you might want to look into that as well too. Do you have another question?
Yeah, sure. Leon asking, do you think NAC will ever be permitted?
Do I think what?
NAC will ever be permitted?
That would be the Pebble deposit in Alaska. This is my opinion, and I could be wrong, but my opinion is based upon the fact that mining companies are so involved in what's called ESG, environmental social guidance, and it's getting more and more difficult to permit a deposit in an area of the world that has other issues with it, whether social issues, whether environmental issues. Pebble has been an uphill battle for a number of years because it's located in Bristol Bay, near, actually above the sockeye spawning ground of the world's largest sockeye spawning ground of a number of different rivers. It has massive amounts of relatively low-grade gold and silver and PGMs in it. It's questionable how that would affect the environment. I think the odds are against it. Nothing is ever 100%, but for my money, I would look for places that don't have the environmental issues that really trigger people that Bristol Bay does. I mean, you can look at places in Chile, for example, for copper deposits that are not near rivers. They do have a shortage of water for working the deposits, but there are permitted deposits in British Columbia for copper, for example, or ones that are near permitting that don't have that kind of an issue. So it just depends on how the individual looks at what might happen here. And I think that Pebble is a long shot, and it would be a mine on the scale of Grasberg in Indonesia. It would probably be run for over a century. with tailings dams and all the issues that that implies. Whether or not that could be safely done for 100 years, I honestly don't know. So I think the people that want to put it into production are well-meaning, but they really have a lot of things that they're going to have to overcome if they want to have a real shot of bringing that into production. I hope that gives you some kind of an answer.
Thank you. Can us that are not US citizens can do all of this?
U.S. citizens can do just about everything I discussed here. For example, I talked a little bit earlier about the Canadian mining stocks. I can tell you for a fact that this year I have bought 4 different Canadian mining companies before they became available on a U.S. exchange. I bought them on the TSX. My brokerage account, which I have at Ameritrade, enabled me to get on the phone and buy it, with a limit price. They put it into my account as a .cn stock, and those stocks have all become OTC listed stocks now, and so I accepted the bigger bid-ask spread to get involved with them. I'd done the research, and they are now in my account as OTC stocks. Not all brokerage firms enable you to do that, but if yours doesn't, I think you should get one that does, because it really gives you an opportunity if you do your own original research. And the Morgan Report has brought a couple of these companies to our readers' attention before hardly anyone in the U.S. knew about them, and they were able to go research them and go to their website and whatnot, and take a position in. And now they have good profits for companies that should go up even more from where they are. So if you learn how to walk the ropes, you can do this legally and without a great risk, but always go in and out with limit prices, whether you buy on the OTC or on the TSX.
The other question is, do you have any juniors that you like in Nevada?
I'm really hesitant to give out names, not because we're trying to keep everything a big secret, but I don't want people to overcommit based upon something that I think might work that might not. But let me say this, David Morgan, and I subscribe to this completely. We have a 3-tiered situation in our report. We have an asset allocation table, majors, juniors, and which juniors are being pretty much producers, and speculations. And the seniors are the big companies that produce a lot. The risk is relatively muted, but so the reward might be a little bit less than the junior. You accept a little bit more reward. They're producers. They need to grow their resources. The speculation plays, we recommend that you put a little bit in each one if you're going to get involved. Put small money in for the possibility of making big money. Now, sometimes we choose to put a fair amount into a play that we think has a lot of potential, but that's us. You can do that too, but we don't recommend it, but you can. And that's one of the ways to make an outside return if you want to accept an outsized risk. And so it's up to the individual, and we're all responsible for the decisions that we make. I will say this, you can go to YouTube and you can see a lot of companies coming out there now that are raising money for their projects, and there's a lot of them you've never heard before of too. I would try to stick with companies, the exploration companies that have been around for a while, that have showed progress, that are increasing their resource and their reserves. And some of these ones that just got started, unless it's a name that's been out there and be successful before, like a Ross Beatty or a Dr. Peter McGaw or someone like that that's done it before and will probably do it again, you might want to avoid somebody that you've never heard of before, or someone like Dr. Quentin Henning, who's done it a number of times, or someone like the people that backed the oxygen.com. They've put 4 mines into production, which is a very unusual feat, and they're working on a couple more. So find ones that they are working on that are relatively unknown, and that's where some very large profit potential can occur.
Do you talk more in your report about the digitization of metals? Sorry for my Ukrainian English.
Yes, we do. About 2 years ago, we started a blockchain brief column, which we update every month with current information, with ideas, with interviews, with links. And the idea is to inform our readers about the blockchain space because it is and will change everything. We do not see, for example, Bitcoin competing directly with gold or silver. We don't think they're going to replace each other. We think that they are companions in a massive paradigm shift that's going to bring honest money back into circulation, even as the central banks seek to destroy the ability of people to have privacy and to have fiat money, which they are out and out stating that they want to make worth less and less every year. And so what blockchain is doing is enabling the ability for people to have a different option to digitalize their gold and silver. It's giving them an opportunity to go to banks that trade in digital coins, and it's a new area. But these are getting regulatory approval, the better ones. And if you go and study these things and look at the links that are provided, you can inform yourself. We learn more every month, and so do our readers. And we just last month added 2 altcoins and a digital mining company to our asset allocation tables. We've never done that before. And we profile companies that we don't add, and it doesn't mean that you shouldn't consider buying them if you like them. I own several in my own account that are not in our tables. We don't try to list everything out there that could be really good because it would be too unwieldy. You can't hold 50 or 100 stocks and keep track of them. So we try to find the ones that we feel the best ones for our readership that make the most sense. And they're going to, they're doing very well, most of them. And as Doug Casey says, you can't kiss all the girls. So there are others that we don't talk about or that we do talk about and don't list that can do very, very well. But we have ones that we think give you a really good shot to do well in their own right. And David Morgan has profiled more exploration plays that became miners, producing miners, than anyone else in the sector. So that can help you avoid some of the pitfalls of buying ones that don't hunt, and yet at the same time getting an idea to do further research on ones that intrigue you.
Thank you, and I have to pick the last question for today because we are running out of time and GoToWebinar are going to be automatically shut it down. So the last question would be, could you please clarify more about the offer? It's just to subscribe to the D report, or how they can participate in the investment ideas? Trader asking.
Now this is for the Morgan Report?
Yeah.
Yes, they can go to themorganreport.com and see if they'd like to subscribe to David's letter. There are 2 levels. There are the premium level and the mastermind level. And he also has a consulting level. They can also subscribe to his weekly report and there's a link there for that as well too, which is free. We have a lot of people who start out with the free letter and they go, you know what, this makes a lot of sense. I want to become a subscriber. So that's a way to go at it too. David presents, and I do too. David has a lot of presentations on different conferences like the one here that I'm at today. David has presented for you too, David Morgan, on your show before. And these oftentimes are put on YouTube, and some of these are posted on our own site. So this is a really good way to get a content-rich environment for the individual and have them come up with a plan that works for them and then execute it based upon what's going on. And we think this is the best time that you could ever get involved for what's going on, and right now is a good time to be doing it.